Hi everyone, welcome back to Be Rich. It's me, Vinod, and today I want to talk about Dmart. I put up this post on the 52-week challenge group on Instagram. If you're not there, do join us. We do have interesting conversations and we're trying to learn together. So what is this Dmart? Well, Dmart is a curious case because it's not in a 52-week low. You take 104 weeks and we're still low. And all of the companies and shares, if you look at where FIIs have been investing and DIs have been investing. If we even look at 1 year ago, we're still up 30%, 40%. That's why companies like, our favorites, which we talk about, like our Reliance, and we talk about any of these Trent, Titans, any of these big Tata companies, if you go look at it over a year, that's why Anand keeps saying it's still expensive, because he keeps saying it's a diamond needle. It's still up 30, 40%. And if you look at the PE ratio is way up. In the case of Dmart, the PE ratio is still up. Yes, they do not have any debt. Yes, they have a great system of selling products to consumers. They're a B2C company. They're not a B2B. What they're doing is they go out like IKEA style. They pick up property on the outskirts of the city and they buy the land and they build these huge retail outlets where they have managed to source at the lowest cost point consumer products, FMCG products such as rice, staples, which we use, and they manage to sell it at a lower price point, at higher qualities. And people flock there, take their cars because there's ample parking, and they load up and they're buying. And this was a strategy and was doing very well. This was pre-COVID, pre-lockdown. During lockdown, the market dramatically changed. People like Swiggy, Dunzo, Zomato, all these guys entered, and Big Basket, they all started offering this services because of the situation world was under, and Swiggy started offering, staples instead of just food. You could buy staples through them, and then Zomato brought Blinkit, and things started changing very slowly, and it became more and more evident. There are usually 5 types of moats which we can talk about. Let me briefly walk you through these 5 types of moat. We have the intangible assets. That means you really can't put your finger on it. Once the brand clicks, it just stays there, which is like Coca-Cola. Coca-Cola is nothing particularly special. It's just sugar, water, what you're buying, and we're paying a premium for it. You just take some water, put some sugar in it, mix it up a little bit, put a little bit of coloring, and that's your Coca-Cola. And you fizz it up, it becomes Coke. Though everyone knows it, though everybody tries to do it, they still dominate the market. So that's something known as an intangible asset moat. The second type of moat is something known as switching cost moat. That means you have bought into a certain system, an ecosystem, and you can't switch out of it. For example, something like Oracle. You have set up your complete database, backend, everything in an environment. Switching out of that and going into something involves a huge cost. So that becomes prohibitive. So that can cause massive disruption throughout your organization. So that is a kind of a moat. If your product or something, NVIDIA is doing this very well in AI because of the way they built their software for their hardware. So that's another good example. The other kind of moat is something known as the network effect. That is keeping volumes and captivity up, right? A lot of companies do this, and it's a network effect, your name and your brand, and it is built on that. The fourth kind of moat is what Dmart was sitting on, was known as cost advantage. Cost advantage is you are 2-3 rupees cheaper than everybody else in the market offering the same quality or better quality. That was the cost advantage network. But where things went different for Dmart is when we come into the last one, which is the efficient scale moat. The efficient scale moat is where Swiggy and Blinkit and all these other guys are starting to eat into Dmart and destroy Dmart's cost advantage moat, is because they have efficiently scaled up and they've moved in where Dmart should have been. That is in the app environment. Dmart has missed this boat. You see now Zomato is there with Blinkit. You see Swiggy is there with Swiggy Instamart. The new Tatas have bought Big Basket and they're trying to make inroads into this. Reliance, with their Dunzo, not much is happening there. Really not clear what they're doing, but they're also in talks of this. All of these guys have started and that market has become very tight and closed, and Dmart seems to have missed the opportunity there. They had the network, they had the cost advantage, they had the back end, right, the logistics for this. If they had launched a Dmart app, much like what Swiggy had done or Zomato had done during the lockdown COVID times, and they were able to scale this up and move forward with this, it would have been a different game. And this has become very evident. And that is one of the main reasons why I see in the long term, until unless something dramatically changes in Dmarts, the way they're doing business, it's going to be proving to be difficult. Because in this K-shaped recovery economy we are in, people who are there on the higher strata of society, who are on the upper side of the K, will not be worried about the 2 rupee discount, 3 rupee discount. They would be more looking for convenience, and they would prefer using something as a Swiggy or Blinkit or any of these other apps to do their purchases. Most of the people on the K-shaped recovery also do not buy in bulk. So that's where the upper echelons of the K-shaped recovery is, which is fueling all the Swiggy and Blinkit, and all the bachelors also are fueling this. The second strata of society, which is known as the middle class, who would be the prime target for Dmart, will find it nowadays, the current economy and environment, in middle class and lower middle class, going all the way to Dmart in the outskirts of the city and doing their purchases in bulk and coming back and stocking it up. I don't see that happening anymore. The trend seems to be in middle class India more and more. As I talk to my middle class, people who work for us, who are in that segment of society, they are more and more, they're saying they're going to the Kirana stores nowadays. They're going to the small mom and pop shops nearby. And a lot of them run up credit like how they used to before, because the economy has changed. A lot of them use credit facility in these stores, which Dmart does not offer. So the environment is changing rapidly in urban environment where Dmart has set up these stores. Well, this is my read of it. And if you feel that I'm wrong, there is something I'm missing in the story of Dmart, please do come and join us in this challenge group and let me know where we are going wrong in the story of Dmart, and is the Dmart moats very secure and safe? And this is just a temporary thing. In 3-4 years' time, they'll turn it around. Because mind you, they do not have much debt. They have a lot of reserves. So maybe there is something happening. Maybe there is something in the pipeline, which I'm not purview to. But looking at it, this is why I would not think, though they're in a 104-week low, Dmart would make sense to me right now. And also price to earnings, if I look at, and the current downward trend in the inflationary economy we're in, the environment and the weather is not great for Dmart, is what I would feel. So what would then be the options in this current situation, Vinod, if you had a little money? Well, I would say the things on our list are looking brighter and brighter. The NATCO, even today, as I'm recording, is in correction, though the market has gone through a dead cat bounce from what I can see. But companies which we take into consideration, such as NATCO, Manappuram, are all in correction today. They're all in the negative. And even the companies which we usually look at, such as the Reddies, the Gold Bees, are still at enviable positions. And of course, let's not forget IndusInd Bank, though it is up slightly today, less than 0.5%, it is still in consideration. It's very close to its book value. So the reason why I'm saying is, we tend to get lost. It gets boring. So every day we're talking about IndusInd, every day we're talking about, Dr. Reddy, we're talking about NATCO, and it kind of gets repetitive, and you see these videos coming from me and my brother where we're talking about this over and over again, and like, where is the variety? What is very boring. Can we look at the Dmart? That is where we tend to make a mistake as investors, and that is what gets us into our problem. When we forget this is not entertainment, this is not our life 24/7. This is something we require to do to make sure we, put our money away in such a way that it creates wealth for us later in life. It is as foolish as spending time looking at, your bank balance through the day, morning to evening, and seeing how much interest the bank is giving you today. It'll be very boring if you did that entire day, if you keep logging into your bank account over and over again. So that is the same kind of philosophy. If you've got some cash to invest today, Tiffin Coffee range, you've got your list, and look at it. A lot of you keep on asking me in this group, what about this company? What about that company? I want to know why. So that is why I took this Dmart issue, because Dmart was someone was talking to me about Dmart. So I threw it out there to ask, yes, it is, coming to close to being lower than what it was 2 years ago, but I still don't see value in it. And mind you, I would say this about any other company which is reaching this range. And if Titan, Tata Consumers comes to 104-week low, then we definitely will take it up and discuss it here if it comes to value. And if the moat, whatever we think the business model is secure, because that is also fundamentally true for any company, including Tata companies. Even the great Tatas have made mistake and gotten out of businesses. We all know about what happened in Tata Docomo. So, there are situations that people make mistakes and then they try to take course corrections. The reason why we stay invested in a company like the Tatas is Because if they lose, we lose. But if they win, they make sure we win too. And that kind of transparency and being ethical for a small retail investor goes miles. And this is like the exact same reason why, though the shares of Adani today, I think what's happened with Adani, like the Adani stocks, some of them are up, some of them are down, not really moving anywhere after getting the beating yesterday. I do not venture into the Adani place because he's huge. I'm small and he can afford to shut down a business, and let it burn and move around. I can't afford to do that. So with that kind of lack of clarity, it's better to stay in lanes which we know, where we know what the owners of the business are doing. We see a track record for a long period of time. We can see their earnings and we see the potential of future where it's going, at least for the year or two. There's some kind of a clear roadmap and they steer from controversies and they're not trying to grab headlines. And that is the place I would like to be in. Anyway, I hope that gave you some clarity with Dmart and where you can look at for the next few days. Yes, today market was looking like a dead cat bounce. I do not know what will happen in the second half of the day. Once the Europeans wake up and the European markets wake up, that usually happens post-lunch in India for us. That's why that day when I saw the market was moving up, a whole 1.5%, the index was up. And then we saw a dramatic fall where it almost went negative last week or the beginning of the week. But that may happen today too. Even when that happens, do stay in tiffin coffee ranges, like I keep saying. Like we've seen Indocin come from 1,200 when we've been saying you can consider it. From 1,200 has come down to 900. It might even go down to 800. I don't know. And if you keep doing tiffin coffee and you won't feel so terrible. If you had sunk in, let's say, 12,000 rupees at 1,200 in Indocin and that 12,000 rupees now is 9,000 rupees within a space of a few weeks, no matter whom you are, you'll be feeling a little angry with yourself about it. And that's understandable. So that's why I keep saying buy in dips and you're much better off doing that. And don't get enamored by these kinds of news items and clickbaiting things you see on the news about certain companies and certain stocks, because we do not really know what the motivation is behind that article. So do your research. And if you believe in that, and have discussions with other people who are like-minded like you and see how the discussion goes. After that, then think of investing in small tiffin coffee ranges is what my advice would be. Other than that, nothing more to say. Do have a wonderful day tomorrow, and I'll catch you again tomorrow evening with hopefully some more interesting news about what's happening in the market. And definitely, if the market has turned negative, or the FIIs, or if Ukraine and Russia, something interesting happens, I'll definitely bring that in also. Again, thank you for watching the video today. Do like and share and subscribe and do all those nice things. And I'll see you again tomorrow. Thank you.
Hey guys, that my uncles Anand Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends, and a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it, and please give us comments and feedback on what you read. Thank you.